Hey guys, what if I told you about cash flowing real estate investment opportunities that you could get into without having to get a loan or worry about fixing toilets? What if I told you that this investment had doubled in value last year? Well, stay tuned because in today's episode, we're going to talk about real estate investing opportunities in the green rush.
And the big question is this: the green rush was a $10 billion industry last year. Experts say it's going to be worth over $20 billion by the end of next year. How do normal people like us, who didn't cheat by being born into the 1%, how do we use the money from our own pockets and participate in this massive wealth creation event while building financial freedom for ourselves and generational wealth for our families? That is the question. My name is Charles. Join me as we explore these answers.
Hey everyone, how's it going? We're back for another episode of Green Rush Investing. I'm your host, Charles, and I'm joined by my wonderful co-host, Courtney Richardson, the Ivy Investor. How are you doing today, Courtney? How's the weather in Philly?
It's actually pretty nice. I think we're getting our first bit of spring, kind of, sort of. I'm just always afraid for that, just kidding, from Mother Nature, and we get that hit with one more snow. So It's pretty nice. It's going to be 60 tomorrow, which is great. It's been kind of cold, but I'm just, like I said, really concerned about us getting one other storm, because every so often we do get a really big storm in March.
Nice. Well, speaking of shocks or unexpected things, I wanted to just point out, I was watching CNBC earlier. Do you see my screen okay?
I can.
And of all the people out there, right, this is Bruce Linton. He is the CEO of Canopy Growth Corporation. I would, for all intents and purposes, say they are the big dog of cannabis growers out there. We've obviously had our own opinions on them and whether or not it's a stock to invest in. It is still a company worth watching because of everything they've done in terms of leadership and growth, and the $4+ billion Constellation Brands investment. That definitely does something for the company. But what I really want to point out, and I'd love to get your opinion, is this irrational exuberance? Is this genius? Or is this pure lunacy? Is the quote. So I'm sitting here, I'm just watching Bruce, I'm listening to him talk because I love understanding where he's at, because he's definitely the trendsetter for the industry. And he states this on, I think this was national, maybe it's international TV. I do not wish to be complimented on my extraordinary clean balance sheet. What are your thoughts?
It's exciting, it's scary, it's kind of crazy. It's all of those things together, because conceptually, as a disruptor, especially in this industry, as this industry is a disruptor and it's a game changer, because we're moving from prohibition to, kind of sort of a not even quasi, just regulated industry. So completely bad. Now we're kind of okay. So we're looking at this disruption over across the board. So again, when you're looking at a disruptor, saying that you have an extraordinarily clean balance sheet as a disruptor, I get where he's coming from. Maybe we're doing this wrong. Maybe, we're not taking enough risk where we are. So I think I get it. But then on the other side, as an investor, I'm like, well, wait, where are you going with this? What do you mean? And I don't one of the things that I look at as a fundamental investor is I look at the balance sheet, what's going on with the company. And one thing I will say is that they look pretty good on their balance sheet. And now all of a sudden you want to mess that up. Well, wait a second. Well, what is this? What does it mean? And as an investor, if I was investing in Canopy, I'm kind of I don't know. But I can see if we're doing this as a long play or a long-term play, I can really see where there may be some value maybe 3 to 5 years from now, and kind of mixing some things up and really kind of being, the forefront of the industry.
No, I totally agree with you. I mean, given the growth and everything that's going on, I totally empathize with go baby go. Then there's the fiscally conservative conservative side of me, right? That likes to make sure I have enough savings to cover, I've got my rainy day fund, I've got my lightning fund in case the rainy day fund doesn't make it, I've got the other fund. I'm just fiscally conservative. I don't like to take on debt. I don't like to do anything. And then I hear something like that, and I want to go ahead and I want to say, go baby, go. But then it just definitely gives me a bit of the heebie-jeebies. But I think what's interesting to say, and this is also just an investment, a little pearl out there. I think it's also worth stating that there's definitely a lot of opportunity and high growth, but we always need to remember that these are very speculative and risky investments. And we should not, what's the classic saying? Don't invest more than you can lose. And it's not that you want to lose the money, or maybe you can talk a little bit about that. What do you mean by when, because I'm sure when you're educating people, you say, don't invest more than you can lose. People just kind of look at you cross-eyed. Why would I invest money to lose it, right?
Right. So generally, I think looking at investing overall is that you have an expectation of growth, but on the same side is that you can lose money. I mean, when we go to a bank and when you think about banking, like our money can only go up. It can either stay the same if you're in like a no fee, no frills checking account, or you can go up if you're in like a money market or a savings account. But kind of that ability to go up or that ability to increase in terms of that account, those savings accounts, those banking products, it's relatively small. I mean, you may be getting, if your average savings account, you may be getting like $1 a year, if that.
Maybe 1% on a good day, right? Now it's probably 0.5%.
So you're not getting, and granted, like I think Ally might be around 2 now, but still that's nothing. I mean, if inflation's at 2%, you're just kind of breaking even when you calculate inflation into it. So when you go into the market, you're looking to get a higher return or a greater return than what a banking product is going to do. But on the other side is that when you're looking to get kind of the higher the risk, the higher the return, the greater the risk, you have this kind of for lack of a better term, unlimited upside potential. But at the same time, you have kind of this bottom that could fall out the bottom. So you're saying like, listen, I can go all the way up here, but I can lose all of my money. So that's kind of when we're talking about investing, is that that basically sky's the limit, but it couldn't go down. So I think it's really important that we look at this in context as an investor and understand, listen, if I can't afford to lose this money, because that could happen, a company could go bankrupt. And if the company goes bankrupt, then you're basically out of luck. As an investor, your investment is gone. And as an investor, that will happen. And I think that's happened to me like maybe 3 times in my entire investing career. And I was looking at industries not kind of on the lines of cannabis. So I was looking at an oil and gas pipeline company. They were doing amazing. And then the bottom fell out of the oil and gas industry and that company went bankrupt. So this happens. And so when you're looking at even we can look at Sears. When you look at Sears, you're like, Sears has been around for over 100 years and all of a sudden it's now bankrupt. So again, so you have your stalwarts that have been out there forever. And then you have these kind of up and coming industries, and anything can happen in business. And because of that, anything can happen to your money that you have invested in your business, in a business. So you just have to be very mindful as an investor. So that's what we mean when we're talking about you can lose everything and anything, and you basically lose your entire investment. So if that's the case, then you have to be a prudent investor and not invest more than you can lose.
Definitely. And that's definitely a very smart thing you just said, Courtney. And it's a teachable moment. And I'm actually going to take an aside for everyone who's still tuning in and paying attention. We have some giveaways. So pay attention to what Courtney says. We are going to do a pop quiz at the end. And if you're on, if you get the answer right, and there's no limit, we will be sending you a free copy of this wonderful book we have, How to Succeed in the Green Rush. Wonderful book, over 90 pages of exercises and questions and information to help you get started and become successful in this growing industry. And stay tuned and we'll tell you more. So now let's dive back into this statement. So I got this statement, it made me wonder, but then I thought to myself, I said, okay, let's be realistic. This guy, Bruce, right, 3 years ago, or even, 3 years ago, Canopy Growth was, I don't want to say it was nothing, but I mean, it was maybe worth maybe $10 million. I mean, it was a small little business. And literally in the span of 3 years, this guy has turned this business into what the valuation I think now is over $10 billion, maybe even $20 billion in terms of a company. And he's made himself a billionaire, I'd imagine, given all that. So I'm thinking to myself saying, okay, I heard what that said. That kind of set me off, but this is a guy who's probably pretty darn smart. He's definitely smarter than me. And there's probably something brilliant behind, like there's a strategy in there, I feel.
Right.
So what I felt, and this is kind of, I did some digging and I want to just get your opinion. And I saw this, but after doing some research, I then saw this. And what does that mean? Maybe Canopy could spin off into a REIT or do some financial engineering on the back end side. Now, this is interesting to me, right? Because I look at Canopy Growth. They've got over $1 billion worth of hard assets, including almost $4 billion in cash. They literally have very little debt, maybe some convertible notes and some leasehold expenses. And that's incredible. And the main thing is, I can see how Bruce is looking at this. He wants all of Canopy's assets, their equipments, their facilities. He wants them all hard at work in terms of growing cannabis, grabbing market share, and building the next generation massive consumer brand in this green rush. And this guy, I look at him, right? He's a savvy businessman. He's probably a multi-dimensional thinker. And he does this by, how does he do this, right? He's probably looking at how do I get his passive assets, his real estate holdings to work just as hard for his shareholders as his active assets, his business investments, his growth investments. So my takeaway, and when I'm looking at this REIT, it really gets interesting because as I dug deeper, I found that he's investigating a variety of options for Canopy Growth. Things from sale leasebacks to mortgages, secured or unsecured bonds, and this concept of putting a REIT together. And a REIT's an interesting idea, and I think it'd be an interesting discussion to have for our listeners who might not understand what a REIT is. Maybe what I'll do is I'll give the basic overview, and Courtney, you being the real estate expert, can talk more. High level, what is a REIT? A REIT's a company. It owns a bunch of real estate. It leases it out. And there's a special type of structure, I think, right? Because since it distributes dividends, it doesn't have to pay taxes. Do you want to maybe dive into a little more about how REITs work and why they might be beneficial for some of these private companies or even public companies?
So REITs are a really good vehicle to use. And just to kind of give a background on what a REIT is, stands for Real Estate Investment Trust. So it's a trust to basically a basket of companies. And to your point, Charles, in terms of taxation and why it's even interesting for most people is that with a corporation, you get taxed on two levels. That's why they call corporations double taxation, because they get taxed as the business level, but then the dividend, or let me clarify, the shareholders get taxed on their dividend when they receive that dividend. They have to pay taxes on it. So that's what they mean by double taxation. But the thing is that the REIT is for lack of a better term, it is a corporation, but it gets a special designation in the tax world in terms of that first level of taxation goes away. So everything passes through to the shareholders, which means basically just think of it this way. If you had money just kind of floating around that you weren't getting taxed on, and then so that means that more money is available. So more money is available to shareholders and via a dividend. So their dividends are going to be a lot higher. And it just ends up working. Now, one of the things that they have to do to maintain their REIT status, at least in the United States, is that they have to distribute at least 90% of their profits. So that's what the difference is. So the government says, listen, we're going to, and I want to make a kind of a point, is that real estate is the most favored asset class in the tax code. Period. It really, really is. I mean, you have anything from the 1031 exchange to the ability to the depreciation aspect of real estate. There's a lot of things tax-wise that you can take advantage of on the real estate side. And to talk about real estate generally, like I'm a real estate, I guess, expert, and thank you for that. But I'm not like a person that's like, oh, real estate. I think that's part of your diversification of your portfolio, is to have access to real estate in addition to the stock market, because pretty much they're inversely, we talk about them not being correlated with the stock market, except in 2008, and that just happened. But normally if real estate's up, the stock market's down, and it kind of just acts as a balancer to a portfolio. But so I really like to bring that up, is that a lot of people don't understand what real estate can do in terms of like helping your tax liability, because when you have depreciation, you're able to kind of, to the most part, depending on how you're set up as a company or as an entity personally, you may be able to kind of write some of that off against like your active income or your active, active capital gains, I should say, for lack of a better term. So there's a lot that goes on. So I love REITs. But anyway, so back to what a REIT structure is that I think Sears actually did this too. They have what's called Seritage Holdings. So they spun off their real estate assets not a long time ago, maybe about a year and a half, 2 years ago. So there is kind of a basis for this kind of idea in terms of spinning off or kind of separating out. And it is a great way to leverage assets. So basically just think of it as a basket. Like think about it as like a mutual fund for real estate. So it's a basket of properties that are held together. They're not taxed on the corporate level. They're only taxed in terms of a dividend. So that means the dividend payout is significantly higher. And it's actually a really good way to kind of hold real estate overall.
Yeah, no, I don't know if it's as, I might go out on a limb and say a REIT's like having your cake and eating it.
Yes.
You get the benefits of real estate without the liquidity issues, where you've got a mortgage and transaction costs and everything on that. So diving in further, what we're saying is, the structure, something like this, it's been done before. Courtney gave the example of Sears. The telecom industry is well renowned for that, whether it was Verizon or AT&T. They used to own these massive tower assets, and they spun them off as REITs. And regardless of how you look at it, this is a structure that could potentially unlock even more value within Canopy. And we always like going back. I'm a big believer of history, not because I'm predicting the past, but I learn from history to give me guidance towards the future. And I want to talk a little bit about a cannabis REIT that I like a lot, or that I used to like. I still like it, but not as much as before from a valuation perspective. But I think cannabis REITs already have a history of generating a lot of value in the market. And for anyone who's tuning in, this is a company I like a lot because there's a lot of good things that I usually don't see in cannabis stocks, and we'd love to get your feedback. I mean, first is, this is a company that's profitable. Right? So how many cannabis stocks are profitable, right? Yay, they're profitable. Second, this is a company that trades on a major stock exchange. So it's not sitting on some sketchy Canadian OTC thing. This is major. And now this is a legitimate enough company that it's part of the S&P small cap 600. So it's part of a small index, which is, you're talking legitimacy. This is a legitimate company. And then thirdly, I like this company because it pays a dividend, right? I mean, imagine you get appreciation and you get cash flow on that front. And what's fascinating about this company is their dividend payments are so high that it would possibly, just by owning it, the dividends alone will double the value of your investment in maybe as much as 5 years, given the compounding nature of how that works. And the great thing is, with all this stuff, it doesn't even include the surging stock price. Right. So who is this company? In case you missed it, it's called Innovative Industrial Properties. It is a cannabis REIT that currently trades publicly on the NYSE. And for those of you who've been following us in our web class last spring, the Jarvis team, we actually gave out IIPR as one of our recommendations, saying, hey, this was one of those ones to get in. Now, did you get into IIPR? I know we weren't really working together back then, but were you able to take a position on IIPR? Or?
I didn't. At the time, I felt like they were overvalued. I did share it with my class, and I told them I did share it with my class, and then I had I did have people reach out to me saying, Courtney, I'm so glad you put me on the IIPR, and I'm kind of going,
oh man, well, if it feels any better, I mean, I missed it on Canatrust a couple weeks back, so no one bats 100.
Yeah, and that's true. And the thing is that sometimes I'm in the industry, and I looked at it, and then the next thing I turn around, I was like, oh my, because initially maybe October of 17, I think it was doing like, maybe it had like a 1% dividend. And it just wasn't, and it wasn't really kicking off that much. And I was like, and I wasn't, because they actually focused on the United States, and they focus on rentals or kind of property management in states that have cannabis, I guess, setups, or anything that has anything to do with cannabis is like kind of what they're renting out, which is awesome. And I thought it was a great thing. But then I was also personally scared off a little bit by the Sessions memo. Well, not the Sessions memo, just in general, because he basically rescinded the Cole memo and said, listen, we're returning to the rule of law. And I said, okay, this is an ancillary company, but this company is going to be adversely affected if he actually does kind of make good on his threat/promise.
Yeah, no, that definitely drove the stock price down, and we'll dive into that more. But from our perspective, when we made this recommendation back, I think in May, the stock is up over 100%. Pretty happy, 1 year return of 100%. And in addition, their dividend's been running around 15% over the, or not 15%, but it's been on a 15% run rate. So that's massive. I mean, you get the cash flow and you get the appreciation. I mean, from an investor, a rapidly rising stock price with consistent cash flow, I mean, that's pretty nice.
And I want to really point out that doesn't happen a lot. Like, normally it's either or. It's really just like, okay, I get this, I get this consistent I get consistent cash flow from a dividend producing stock, but I'm not expecting what we call capital appreciation or a stock to rise dramatically. So in this particular space, it's really doing well, because this is not, I want people to understand that this is not normal. And it's not normal, but it's good on a not normal thing, because you're kind of getting the best of both worlds, which usually does not exist. But when you're in this kind of budding industry, you're going to have kind of like these unicorns stand out against everything else.
Well, I think it's a good point to make. This is why I like industries like this, and I suspect you do too, right? With these new industries, yeah, it's a little shaky, maybe there's a little volatility, but the opportunities for massive growth and windfalls is amazing, right? I mean, any other REIT, let's use the Sears example. I don't know those numbers or any of these other REITs. What's the possibility of collecting a 15% dividend and at the same time doubling in value without, it's not happening. I mean, even if you did your own properties, it'd be like, can I buy a foreclosure and immediately rent that thing out in cash flow at 15%, or you'd need more because you have to actually run the real estate.
Yep.
And at the same time, be in a spot where the market is appreciating literally 2x, right? So it's like, can you, that just doesn't happen. And doing it with no work, because buying a REIT, just I click a button, I own some shares, and hey, I kick it back and let people do all the work. Now, what's great about IIPR is, like Courtney said earlier, it buys properties only from licensed medical marijuana companies. Right now, they aren't doing recreational. And even though there probably still is some risk, we made that decision because it was like, okay, maybe Sessions was going to happen, but recreationals, medicals at least a level above, and people were licensed, and, states were legal. So the probability of someone clamping down on a medical facility, I felt, was a lot lower, and our team felt was a lot lower. And most recently, IIPR, and just give you an example of a transaction, they were working with a company that had been operating cannabis facilities in California. They paid almost $7 million up front for the building, which was located in Sacramento, and they're leasing the property back to the operator. In addition, IIPR is committing additional capital to the amount of another $5 million to improve the property and help them grow better. And with this transaction now, IIPR owns 12 buildings across 10 different states, including major high-growth markets like Massachusetts and New York. And this process of, selling and leasing back the property, some may call sale-leaseback transactions, might seem unnecessary, but specifically in the cannabis space, it's a very valuable service. The reason why is there's this issue in cannabis with banking. And by doing so, IIPR effectively acts like a bank, right? It gives capital to a growing company so the money doesn't have to be tied up in real estate. And then IIPR benefits because it's able to charge extraordinarily high interest rates comparative to traditional markets in the form of rent to continue using the property. And because most banks are still kind of leery of working with cannabis, it's still not federally legal, IIPR is able to charge much higher rents and compound quite nicely. And what are we talking about higher rents? We're talking rents that are 2 to 3 times higher than market rates. So, I mean, literally, and I'd love to get your feedback on this. They're getting 15% on their money as a REIT. How does that, I mean, that's astronomical. I mean, from my experience, that's almost 2 to 3 times what landlords can charge based on commercial cap rates and real estate and everything on that front. You agree?
No, that's definitely what happens. And to your point about the lease buybacks, kind of like how that usually works, it's a lot more common than people think and know, but it's a really great strategy for 2 things. I mean, I think the biggest thing, kind of the big picture, like looking down, is that you have people who are the experts doing what experts do. Like if I'm running a cannabis company, I'm not a real estate person. I'm a cannabis company. And adding some of that aspect to it, like I have to manage my property and I have to do depreciation. I have to do all this other stuff. It's a lot of things that that kind of takes away from the work. So when I talk to my students, I usually say the riches are in the niches. So I like looking at companies like this because they're saying, hey, I do cannabis, you do real estate. So you do what you do, I do what I do, and then we'll come and meet in the middle. So I think this is a really great model. And a lot of companies I've noticed, I've been looking at companies in the United States and how they've been working is that they're trying to cut off as much as they can that's plant touching and trying to so they're basically being able to take their deductions if they can. They try to put themselves in a better position to say, if the less I can have that touches this business kind of thing, the more I can get a deduction. So kind of allowing their leasing to kind of go through another venue works out better for them in the long run and looking at their kind of scope, if that makes sense.
Definitely. And for everyone who's still tuning in, don't forget, take good notes because pop quiz is coming at the end and you'll get a free copy of Dashida's book, which is, I mean, this is free. We're not going to charge you shipping. We're not going to do anything. We'll say at the end, we'll give you a few things to say, a few things to comment, and we will ship this to you, a $19.99 value, free to your place. While you're on, if you're still on, if you can comment with any questions, share this post, we'd really appreciate all the love. But now going back to IIPR, we've talked about the appreciation, but then let's also talk about the dividend, right? You said the REIT, 90% has to come back to the shareholders. So when you're the owner of a REIT, every dollar they make, most of it's coming back in the form of dividends, right?
Correct.
That's exciting. So you get cash flow and this. And the great thing about IIPR, maybe the great or the other thing is IIPR hasn't even fully deployed its capital. Looking at the SEC filings as of last September, it still had $50 million in cash on its balance sheet. It just literally in January finished raising another 100+ million. The exact amount was 119 million. And when they deploy this capital, I mean, this will just give it more property, give it more cash, and give it more revenue. I mean, this is exciting, right?
Right. And I think I think this is where that legal aspect comes in, is that as we look at more states that are looking to legalize and kind of move forward with this. And also, I'm really wondering if they're going to use that particular capital to assist with the hemp side of it, because I think that's something that's pretty much a void. So I'm just kind of like, well, what are you guys going to do? You're doing the medical marijuana, but now that hemp is now legal, are you going to step into the hemp facilities also? Like, how are you going to do that? And I think that's probably, if I had to guess, I would think that would be the next move. And I think that's honestly the next logical move. So I really want to see how they're going to use and deploy this capital, because it seems that, especially where they're going, I mean, if you put on the last slide, they're in New York, they're in Pennsylvania, they're in a lot of really big, to your point, heavy cannabis areas. So again, it's like, okay, so you look like you know what you're doing. And this is why I even put them on my radar to begin with. You look like you know what you're doing. You're kicking off a lot of money in terms of a dividend. So that means that you are profitable. I hope I have to go look to make sure they're not pulling from debt, but I don't think they are because they have plenty of cash. But I think it's a really important thing to look at how they're moving. And I want to see like, okay, because if they move into hemp, it's over. It's like curtains. Like, it's like, okay, like the floodgates have opened up, the world is changing because this is kind of like the next big thing, because they've already made, like, to your point, they made a calculated bet, a calculated move saying we're going to only do medical marijuana. We're not touching recreational. But when they kind of step into this legal arena, one of the biggest things is understanding the regulatory scheme and actually knowing how to navigate it. They've already kind of mastered it in this more kind of thornier area. They're really going to take off and understand kind of where that placement is. And that's a big deal in the cannabis space, especially in the United States, understanding placement and getting it right, because it's kind of hard to move a building. So.
Oh, you're right. And the other thing too, I guess this is where it becomes interesting. IIPR thus far has just been going cash-based. And as the market evolves, and you even talk about this hemp, I think it brings a really interesting point of leverage, right? I mean, think about us, right? How many people actually buy, do you buy your house with cash? Very seldom. We always get some bank leverage for that. And REITs, as this, call it legalization or hemp or whatever comes into play, a REIT's able to, they're gonna lever up just like normal people buying real estate. And the more they lever up, they will be arbing if they're charging, 15%. Their interest rates aren't going to be 15%. So they'll be able to take that 150 million in cash they have, and they'll deploy maybe 300 million, 500 million, some much bigger amount, which will definitely make the returns and the cash flow even better, right? So let's say they invest their cash, they get some leverage, they can literally triple their assets and income generating power without actually having to offer more stock and dilute shareholders on that front. Now, the final thing I want to bring up, which really gets me excited, and this is, we're talking about IIPR, but we're talking about just the concept of a REIT in general, because while IIPR is exciting, keep in mind, I got into it last year, if you saw that number, at $34 a share. Right now, it's probably trading at $70 or $80 a share. I don't know if I'd get in at $70 or $80 a share. What I'm talking about is I want to talk about the concept of the REIT, because we believe there are better ones out there. Give this example of what Bruce Linton is doing with Canopy Growth. If he spins out a REIT, we'll be maybe talking about some more options. And for people who continue following us, we always come up with great ideas that you should look into. So stay tuned on that. But we're here trying to teach you the theory of where it can be, showing you a successful investment on this site. Yeah, I mean, you could probably get into IIPR now and do all right. Risk adjusted, I just feel there's much better opportunities, but I think it's still good to see where the end game is. So now when we see that next REIT coming or that next opportunity, we're comfortable and we can really pounce on that one. So you're not kicking yourself, Courtney, for missing out when it was, $30 or $20 a share on that front. So
when you start doing this for so long, you're going to invariably miss something. Really are. And sometimes I can make my best educated guess. And a lot of times I'm more right than I am wrong. And then every so often it's like, ooh, I missed it. But I think you made a really good point about what Canopy Growth is looking to do, because in kind of to link it back to hemp, and I get so excited about hemp. But remember, they're now in Southern New York. So I wonder what this will do. They're now working in Southern New York with hemp. So I wonder, is that kind of maybe what's driving the boat a little bit, to saying, hey, they really do, because they made kind of mention in passing that they really want to get into the United States market, but of course they're not slow. So they said, you know what, how do we get in here without burning ourselves? And now we're looking at hemp. It's like, okay, is that kind of the positioning you're going to take, saying, okay, this is where we can do hemp. We can also do this whole REIT thing too, and maybe we can do them together. Because I think he wants to get messy. And what I mean by messy is that he wants to be kind of innovative, and no play on innovative industrial properties. But I think he wants to be a little bit more innovative, and I really wouldn't be surprised if he kind of mixed the two. Ooh, cannabis in California. I'm very
Now,
excited.
final, before we move on from IIPR, this is the final factor I see that potentially gives it 10-bagger opportunities. And it's
Ooh.
this concept of normalization. And what I
Can we
mean
talk
by
about
this,
the bagger before you go ahead?
well, normalization is basically, I mean, think of the concept of market efficiency, right? Things cannot be efficient for too long. Ultimately, some equilibrium will hit. And what I mean by cannabis normalization, specifically on the leasing side, is that right now, because of the uncertainty on the market, you can buy a cannabis building and lease it at a much higher rate than what normal cap rates are on traditional commercial real estate. Mm-hmm. But over time, as hemp legalization rolls around, federal legalization, all these things go around, real estate has a matter of, right, we've got an arbitrage, we've got a gap right here. Over time, the gap will come close. It has to normalize. It has to come to an equilibrium because markets are efficient, right? And what I mean by normalization is their lease rates are locked in, so the lease rates won't go down. The marijuana companies today are making money off of it, so the other way to match normalization means property appreciation will occur. Now, this is pure conjecture, and this is definitely an educated guess, right. But I have, and again, this is a bet that, it's an exposure. I mean, if it was for certain, it wouldn't be priced in the share, but I think there is a possibility that as legal normalization comes and the medical companies, maybe not the recreational companies, but the medical companies that are licensed have some sort of licensure protection, have those, have the prescription level in there, they will be able to maintain their prices. They will be able to pay what they're paying on the leasehold side, and then the properties will appreciate up to match what are traditional real estate cap rates. So from a property appreciation perspective, we're talking something that literally could be a 2x, maybe not a 2x, but if you look at what cap rates are versus a 15% return or something on that, we're talking a substantial capital appreciation aspect that could occur. Mm-hmm. Love to get your thoughts on that. So that's that. Now, I just want to keep going because we've been kind of dragging and I want to just keep moving. So yeah, under the radar opportunities like IIPR, it's been great. People who had tuned in, actually Deshita had been talking about IIPR back in May of 2018. I don't know if you can see it. The price was $34 a share. Today, it's trading at over $75 a share, up over 100%. Kind of nice. Let's talk about making our money work smarter versus harder. Got to do the comparison against the S&P. Just got to do it. And I know I'm gloating a little bit, but hey, right? If you put $1,000 in S&P 500 a year ago, given where it's at right now, you would have made maybe 35 cents on that front. Versus if you put that $1,000 into IIPR, you'd probably have over $2,000 sitting in your account right now. And that doesn't even count the cash dividends that IIPR has been paying and will continue paying in April. Now, at this point, it's probably a little too late, I feel, to get into IIPR. Not that you won't, it's not a good possible investment that could go up, but risk adjusted, we see some better ones. And I want to just kind of dive into this Canopy Growth spinoff on that side. Now, for people who are still tuning in, if you're too impatient or you just want to start learning more, the link below on this video, we have an investing masterclass at invest.jarvis.io. You can sign up for it. There is no fees, no hidden charges, just a free class that we've put together. Just we want to give up and give back and educate you. But for everyone who's still tuning in, let's dive into this possibility of what we see with potentially Canopy Growth and a REIT from that. So obviously, I'm not sure what your thoughts are, but going back to what Bruce said, he's a smart guy. I'm sure he's seen what's happened with IIPR. It's not surprising that he's, at least from my opinion, that he's considering a REIT. I mean, seem plausible to you, Courtney, or?
Oh, yeah, most definitely. I think now that they're more legitimate, I think they're going to start to look at more I guess, more traditional, more legitimate ways of getting more cash to kind of like race. I don't want to say race to bottom, but they just want to kind of race to grab everything. And so a lot of these, to your point, there wasn't a lot of debt, because a lot of debt, like remember when cannabis started to be a popping industry, for lack of a better term, when it started to pop, banks really weren't feeling them. Like, really, let's keep it all the way real. So they weren't feeling them. So where are you getting debt from? You're getting debt from banks who are giving you financing, but financing wasn't available. So they don't really have a lot of that as an option. So now that they're becoming more legitimate, now banks are going to look at them differently. It's kind of like, back then you didn't want me, now I'm hot, you're all on me. Like, it's kind of like that whole idea. So, but that's what it is. So I think this makes a lot of sense, kind of in the grand scheme of how this industry is starting to go. But I do think, and I think he's honestly the best equipped to do it. Out of all of the Kronos, actually, maybe also. There's some C-suites of some of these companies that I love, because I'm like, you guys get it in terms of getting retail, in terms about getting how to manage a really choppy water. And I think he gets it, and he really looks at a way to say, how can I make this better? And again, how do I kind of utilize the stuff that's not being used? And a lot of companies don't look at at things that way. They're kind of, and he could easily say, I'm already in a interesting industry. I'm already in an industry where I'm already taking a risk. Why take more? And I think that says a lot about him and kind of just his ability to roll.
Well, I think, and again, conjecture, I think it's a fascinating bet, because literally, if Linton built a REIT internally and spun it off, he could even capitalize the REIT or raise some money with the REIT for debt for the REIT to then, quote unquote, buy real estate from Canopy. So where before it was, maybe Canopy has 50 million or 100 million or whatever that number is tied up in the real estate, by creating a standalone REIT that can then raise money, given what IIPR and some of these other companies have done, he could literally generate more cash for Canopy, get the velocity flow of money going, at the same time putting a REIT out, and it kind of splits the company. It splits the company in two, but I think it captures more value, right? Because the cannabis investor is looking at a cannabis company saying, I want growth. I care all about revenue at all costs. Let's go grow that. And that's going to, because it's all about the land grab. Now, the fascinating thing is when it gets spun off into a REIT, it goes into a different category, right? And REIT investors evaluate things differently. So literally, I think this is a situation where, done properly, right? REIT guys look at cash flow, and they look at that cash flow, they apply a multiple, and they'll capitalize it in a whole different level, right? So literally, if I was Canopy Growth, let's say, I don't know what their real estate value is. Maybe they've got $100 million in real estate. They could literally just say, okay, let's take that $100 million out. We'll spin that out. Canopy Growth will just lease the real estate from Canopy REIT company or whatnot. I don't think the price of Canopy Growth would drop, because the investors wouldn't care. If anything, they might get another $100 million in cash in the door. But then having $100 million in real estate, they could then go and become another IIPR or do something like that. And that would, IIPR with their, I don't know what their number is. I think they've got about 70 or 80 million in real estate, maybe even 100 million, but they're trading at about 700 or 800 million. They're trading at a high multiple because of those valuations and because of those cap rates.
Right.
So literally, just by snapping his fingers and doing this, call it financial engineering, he takes an asset that's just sitting there as a cost center, and he turns it into something that's, he creates another $1 billion out of that and generates some extra cash for the company. I don't know about you, but that seems possible. I wouldn't say it's going to happen, but it's an option that's worth following.
Mm-hmm. Almost definitely. I think all of that is worth following, because I think, honestly, and I think generally, they are the trendsetters in this industry. So other cannabis companies are going to pretty much follow suit. So whatever they do, even if you miss it with Canopy, you may be able to catch it with some of the other players.
Well, speaking of catching it, I will bring up a final one that I saw, a company called Treehouse. Have you heard of them at all?
No.
Yeah. Yeah, it's happening. It's not, I mean, it's definitely happening, and you got to look at this. So Treehouse actually is based out of LA, and Treehouse, let me just pull this up. MedMen, Treehouse is a REIT that's focusing on the cannabis retail angle of it. So not growing facilities, they're doing retail facilities. And, oh, I can't log into this. Let me go back and find something. They're inking a deal, or they're working out a deal or something like that, where they've raised close to $130 million or something to that effect. And they're going to do a similar type of a deal with MedMen. It's coming.
Interesting. That's interesting. That's really, and I think, I don't know if we've talked about MedMen. Just they're cool as a company, but I really love their vibe, if that makes sense. Like, I think they have a very interesting vibe, and I think they are very much, they remind me in terms of their vibe, in terms of what Kush wants to portray in the market, is that the CEO of Kush really says, listen, I don't want to be looked at as a stoner. I want to be looked at as a businessman. You know, I'm very, you know, I want this to be legitimized in terms of business. And MedMen tries to do the same thing. Like, they have a very clean setup. It kind of makes you feel like you're walking into, I don't know, like maybe like, I don't want to call it a boutique because I think clothing when I think that, but kind of just a really great experience. So it's kind of like, again, I'm looking at them. I'm like, so now someone's looking to kind of invest in that real estate side on the retail side. I'm like, ooh, this is really interesting.
Yeah, I look at MedMen, and, you know, a discussion of MedMen, we can have that, and I think we'll have to maybe save it for next week because it's about time to wrap this up. But let me just pull up some pictures. I look at MedMen as they're kind of like the Apple Store of cannabis, right?
Yes.
You know, you go to the phone store. I mean, I can go to a Verizon store. It's all right. I can go Best Buy and buy it. But when I go to the Apple Store, it's just a cool experience.
Yeah.
And what MedMen has done, if you can see, I've got some pictures. I just kind of Googled the interior store designs of these. I mean, these things look beautiful.
Yeah.
Let's just go take a look at some of these pictures, right? You look at this, you look at this. I mean, compare this to the dispenser. I mean, the experience is phenomenal on that front. And from a REIT, it's a fascinating thing because, you know, you see PharmaCann on one hand is looking at the industrial grow facility. On the other hand, this Treehouse is saying, well, cannabis is not really about the growing. Cannabis is about the brand and the experience. And from a risk perspective, yeah, it's hard to say. I could see both ways, but it's a fascinating little opportunity, right? Because you say, hey, it's about the community. It's about building these wonderful experiences. It's about building these magnificent stores where people want to experience it, right? Because nowadays, we talked last week about delivery. If you don't have a good store, if like there needs to be a reason for someone to come to the store, not just, you know, go to the shelf and buy a packet because I'll just, you know, open my app and just swipe right or whatever and have some cannabis delivered to my door on that front. So yeah, lots of fun things. I think it's about time to wrap up. Do you have any final words to say? Any final thoughts, Courtney, before we finish up?
No, I'm really interested in Treehouse, so I'm gonna go like digging. But no, I think it's a really great thing for these companies to start expanding their portfolios in terms of really becoming, like, as they legitimize themselves, they're able to kind of really put down roots. I know we talk about plants a lot, but I think that's a good thing. So I'm really excited to watch kind of how this industry matures. And I love watching Canopy Growth go. Like I said, we're always like, go, go, go. But I'm like, ooh, wait, hold on, time out. Let me put my seatbelt on. So really excited about what's going on. So that's my final thought.
Great. And to wrap things up, for everyone who's still tuning in, thank you for tuning in. Let's talk about the giveaway of what we're doing. So to get a copy of the book, all you have to do, just share this video. So share it on your social media, whether it's, you know, share it on your Facebook, share it on your Twitter account, share it out there, and then comment with the link on our video with your share. And then someone from our team will reach out to you and we will ship you the book. Well, we'll ship you the book in the US. If you live in Zimbabwe or Australia and it's going to cost, we'll have to work something out, but we will just ship it to you free. We'll ship the book to you for free. So with that, thanks a lot, everyone, for tuning in. Courtney, until next week, I'm sure we'll have another great topic to discuss.
All right. Sounds good.